Welcome back to the Wall Street Podcast.
Glad to be here.
Today we're doing a deep dive into a really interesting report from Goldman Sachs Asia.
That's right. It's their Moutai 2Q25 results review, just out on August 13th, 2025.
And it really gets into the weeds on Moutai's first half and Q2 performance for this year.
Exactly. Sales by product, by channel, margin shifts, the balance sheet, and their outlook. It covers a lot.
A key look at how a luxury giant is doing. Okay, let's jump right in. What are the headline numbers?
Well, for the first half, 1H25 sales were up 9.1% year-on-year. Net profit also up 8.9%. So it looks like they're on track for their full-year target.
And Q2 specifically?
The implied Q2 numbers show sales hitting RMB 39.7 billion. That's up 7.3% year-on-year, pretty much in line with what Goldman Sachs expected.
Okay.
Net profit, though, RMB 18.6 billion, up 5.2%, but slightly behind the estimates.
Interesting. So mostly on track, but maybe a slight miss on the profit side for Q2. What about the product mix?
That's where it gets quite telling. Moutai Spirits, their main high-end stuff, saw revenue jump 11% year-on-year in Q2. Very strong.
Okay, 11% for the premium line.
But the Series Spirits line actually saw revenue decline, down 7% year-on-year.
A decline? Why is that?
Goldman Sachs points to a couple of things. One, a high comparison base from Q2 last year. Two, and this seems key, policy impacts.
Those anti-extravagance policies we've heard about.
Seems likely. It suggests some headwinds for their, let's say, more accessible products.
Right. Okay, so policy is a theme. How did that play out in the sales channels, wholesale versus direct?
Wholesale channels were pretty flat, just a 1% year-on-year increase in Q2. Modest.
Only 1%.
But direct sales, that continued its strong run, up 17% year-on-year.
Wow, 17%. What's driving that?
Report says it's mainly driven by non-standard Moutai products. And get this, direct sales now make up 43% of total spirit sales in Q2.
43%. That's a huge shift towards direct, isn't it? Seems very strategic.
Absolutely. More control, likely better margins, especially given the policy pressures may be impacting wholesale.
And their digital platform, iMoutai, part of that direct push.
It is. iMoutai brought in RMB 4.9 billion in spirit sales in Q2. Now, that number was actually flat year-on-year.
Flat, so the explosive growth there might be slowing.
Potentially stabilizing, but, it still represents 13% of their total sales and almost 30%, 29% to be exact, of all direct sales. So still very significant.
Got it. Still a major component of that direct strategy. Now, the report mentioned margin compression. What happened there?
Yeah, the Q2 net profit margin dipped slightly. It came in at 46.8%, which is down 0.9 percentage points compared to last year.
Almost a full point. What caused the drop?
Primarily two things. A slightly lower gross profit margin, down 0.3 points, and a higher selling expense ratio. So costs seem to be ticking up a bit relative to sales.
Okay. And the balance sheet. Goldman flagged some big shifts there, too, particularly customer advances.
That's a big one. Customer advances, basically prepayments from distributors, stood at RMB 5.5 billion at the end of Q2. That's down 45% year-on-year.
45%. That's a massive drop. What does that signal?
It likely means Moutai is demanding less cash upfront from its distributors, probably easing the pressure on them, again, possibly linked to those anti-extravagance policies hitting distributor cash flow.
So less cash upfront from distributors.
Exactly. And conversely, note receivables, which is essentially Moutai extending credit to the channel, shot up to RMB 2.8 billion.
So they're actively supporting the channel with credit now, a real shift.
A significant shift. It really suggests they're prioritizing channel health and stability in this environment.
And the actual wholesale price for, say, Fashion Moutai, where did that stand?
The price for original case Fashion Moutai weakened, dipping to around RMB 1,900 in late July. Goldman notes it's seen a slight pickup since then, but that dip is notable.
Okay, let's dig into that policy impact a bit more. We see the Series Spirits decline, the huge drop in customer advances. What does this policy pressure really mean for Moutai's strategy going forward?
Well, it confirms the policies are having tangible effects, right? The actually a 7% in Series Spirits, the negative 45% in advances. Those aren't small numbers. It strongly suggests Moutai is making strategic adjustments.
Like what?
Like actively supporting the channel, as shown by the rise in note receivables. Maybe adjusting investment or focus, perhaps pushing products like Moutai 1935 harder, while accepting that some distributors are under pressure. It's about navigating, not just reacting.
Right, active navigation. And this ties into the channel shift too. Direct sales burning while wholesale is flat. What does this reveal about their core strategy now? And where does iMoutai fit if its growth is flatlining.
The direct sales surge, particularly in those non-standard, probably higher margin products, looks like a very deliberate pivot. They're taking control of distribution where they can, likely to protect pricing and brand image.
Makes sense. Control the narrative, control the price.
Exactly. And Moutai, even if flat year on year, is still a huge part of that direct engine. Maybe its role is shifting from pure, rapid customer acquisition to more sustained brand engagement, locking in that direct relationship. It's still nearly a third of their direct sales.
Okay, so still crucial. Now, despite these adjustments and the slight Q2 profit miss, Goldman Sachs kept the buy rating. What's underpinning their positive outlook, and what are the main risks they see?
Their adjusted forecasts seem to balance things out. They acknowledge the weakness in series spirits due to policy, but they likely expect Moutai spirits, the core premium line, to potentially see increased shipments or maintain pricing power. Resilience in the core.
And the risks.
The usual suspects, maybe amplified now. Regulatory changes are always a risk, think consumption taxes. A macroeconomic slowdown hitting luxury spending is another. And an interesting one they note is the negative correlation between Moutai's PE ratio and U.S. 10-year bond yields.
Right, the broader market sentiment factor. So for the average person, maybe not an investor, but just a consumer, what's the takeaway? Does the Facetian price dip mean Moutai is becoming more accessible?
Probably not in a broad sense. That wholesale dip might create some short-term ripples, maybe for collectors or specific buyers. But the bigger picture is Moutai tightening its grip through direct sales to control pricing and image.
So still very much a luxury item.
Indeed. The company's actions, like extending credit to distributors, reflect wider economic adjustments and policy impacts. For consumers, it likely means continued premium pricing for the top stuff, but it also shows a market, even at the high end, adapting to new consumption realities and government direction.
It's a fascinating dynamic, a luxury giant navigating policy headwinds and shifting consumer access. The core question really becomes, how sustainable are these strategic adjustments for Moutai in the long run, especially as the broader luxury market evolves?
Exactly. Will these moves be enough to maintain growth and dominance? Or is this the start of a bigger shift in China's luxury landscape? Definitely something to keep an eye on.
A crucial question indeed. That's all the time we have for this deep dive. Thanks for joining us on the Wall Street Podcast.